Assalamualaikum. Hey guys, welcome to another episode of this stream where I walk through a given industry and then try and find a few really good picks for companies that I think will perform well over the coming period. And so today I'm going to be focused on the construction industry, construction sector, and specifically talking about home builders. This is one that's performed pretty well over the past few months. Like you can see, total return year to date is about 11%, and in 3 months, 3 months is about 6.5%. So I think it boosted like crazy towards the end of last year, or actually at the beginning of this year. And you can see also that it's outperformed the S&P 500, certainly over the past month. I don't generally like diving into industries where like the price is on the uptick, but I think there's more room for growth. Anyway, I don't know anything about the home building industry, and so what I'm going to do, as I've done in previous videos, is just kind of do a deep dive into the industry, understand what drives the industry, how it operates, how they make revenue, and then try and make some picks for good companies in the industry. So again, we come back to this to Ibis World, where I kind of pull reports on specific industries. So I've got one for home builders here that I'm going to be taking a look at, and let's see what we got. This was updated in October. Very nice. All right. This is what we're interested in. So home builders in the U.S. First-tier suppliers are construction and mining equipment wholesaling in the U.S. Okay, pretty much what you'd expect if you're building a home, right? They construct single-family homes in which units are separated by ground or roof walls with no other units above or below. Ground to roof walls. Okay. So single-story homes. Remodeling of houses and other residential buildings. Okay. All right, cool. So lumber, of course, roofing, siding, insulation, wholesaling. Okay. Yeah, and buyers are finance and insurance in the U.S., as well as public administration in the U.S. Second tier buyers are consumers in the US. Okay, so typically, so you're going to be dealing with you're going to be buying it through mortgage. And so the first tier buyers are going to be the finance and insurance firms in the US. Okay, that's understandable. Obviously going to be impacted by the interest rate, which is the 30-year conventional mortgage rate. Also, a number of housing starts. Okay, housing starts is the number, I assume there's the number of new homes that are built. They must have a description somewhere here. Number of new homes under construction during a specified period of time. Right, okay. Cool. All right, and then what do you have? Number of households. National unemployment rate. Okay. I assume they use so if you're building a home, I assume you're going to be using low skilled labor. And so the unemployment rate is going to have quite a bit of influence. So if there's high unemployment, it's probably going to be cheaper to build homes. I don't know. No, I'm not entirely clear on how the unemployment rate is going to influence this specific industry. Lagging indicator of economic health. Okay. All right, whatever. I'm not going to dive deep into that. Just want to understand this industry. All right, industry at a glance. Let's see what we got. 95 billion revenue. Wow, it's pretty good. And average rate of growth 2015 to 2020 is 1%. Expected growth 2.6%. Okay, that's nice. You have an industry this large that's also expected to grow. That's pretty good. What else you got? So profit margins about 10%. No, 5%. Roughly 5%. 4.3. Okay. Okay. Over the 5 years, industry revenue growth is expected to increase at a faster rate. Low housing supply, pent-up demand. Okay. All right, cool. Looks good. Let's see industry performance. Okay, this is kind of expected performance. I assume here they're projecting interest rates to rise again, and so as a result, you're going to have lower revenue growth. Okay, that's understandable. What else we got? Home builders. Okay. Industry outlook. Okay. Next 3 years expected to be lucrative. And again, low interest rates, I assume, are going to drive a lot of that. Also, coming out of COVID. Steady absorption of existing housing stock will contribute to industry growth. Student debt, dramatic effect on consumers' ability to buy a house. Oh, lowers chances of getting a loan. Okay. So, wow, 2022 is projected to be really good for the industry. Yeah, definitely a mature industry. Okay. Let's see. Major company. I think we're at the point where we have a good idea for how the industry is about, what the industry is about. I just want to understand, breakdown. Yeah, products. Exactly. So, products and services. What do we got? So, exterior homes, sliding exterior homes, siding exterior homes, fiber cement exterior homes. These are the different types of homes. Apparently, these are the popular ones, the most popular ones. Okay. Plastic exterior cladding. I wonder if this impacts basic materials like chemicals. Vinyl. Okay. Brick. Wood. Okay. All right. Business concentration. Okay. This is good. All right, let's see the competitive landscape. I don't want to dwell too much on this. I don't think it's that complicated, and so it's probably going to be pretty straightforward to get a grasp for how it works. All right, nice. So 72% of cost is purchases. We're interested in the specific industry. 13% to wages, 72% to actual items that you purchase. And then profit is 4%, and just a bunch of stuff, other costs too. Okay, probably transportation, others. I don't know. Marketing. Yeah, cool. Okay, this is so useful. So good to know. Like 72% goes to actual cost of material, so cost of goods sold. So you can expect that. All right, so your operating margin is going to be roughly around 30%. And then, no, not operating margin. This is gross margin. So gross margin, roughly 30%, and then, maybe about 10% operating margin. Yeah, roughly. I don't know. Purchases breakdown. What are you purchasing? Oh, subcontracted labor is included in purchases? Oh, okay. I didn't know that. And what's wages? Maybe not for labor. This is wages for the actual staff at the company. It's weird. Okay, cool. Cool. Competition is high, trend is increasing. Okay. Barriers are low. Globalization is low. Okay. Yeah. You don't expect like them to compete with China or Mexico or India, right? Because you'd need to have people locally. So yeah, this is the part that we all care about. Major companies. Let's see. So you have NVR. NVR looks like it's a big player. Okay. Hovnanian Enterprises. That's it. 7%. It's pretty small. So let's take a look at NVR. Let's pull up the fundamental sheet. Take a look at NVR. I also want to see housing starts. Yeah, let me see what housing starts looks like. So, oh, it's actually declined. That's crazy. I thought it'd be up. Why are housing starts declining? 2 months in a row, like the past 2 months, you've seen housing starts decline despite low interest rates. But I think the rise in the 10-year is probably impacting this, right? the rise in tenure. I think it was a roughly 1.6. It went up a little bit. Yeah, it went up to 1.7. Now it's 1.6%. So imagine this is the rate that companies actually use it, like financial firms actually use when kind of this is an input to their calculation of what long-term interest rate is going to be like. So not the short-term rates that the Fed controls, and that they're trying to keep very, very low, at least until the end of next year, right? It's probably not a good thing, right? Forward-looking metric to gauge the outlook for an economy. Yeah, if housing starts are dropping, then it's not a great look for the economy, right? It's down 9.3% versus last year. Whoosh. Okay. All right. That's concerning. That's concerning. Yeah, same data here. That's a bit concerning. Anyway, cool. So let's dive in, right? We were talking about NVR. What does NVR do? Operates as a home builder in the US. Two segments, home building and mortgage banking. What? Mortgage banking? Okay, I don't like mortgage banking because how do you know it's halal, right? How do you know it's halal? You don't want to dive into banking. I don't like the banking part, and I want to understand how big that banking section or sector is, or segment is within the company. So maybe see if we can find a breakdown. I don't have it here. Obviously, I'd have to pull it up in the maybe in the annual report, the SEC filings. So let's take a look at debt. So debt to revenue, pretty good actually. So they have roughly 4 million shares. They're buying back shares. That's nice. 3.69. Yeah, I mean it's been growing a little bit, but not much. Revenue 7.3, done well, 2020. So actual revenue growth despite the business down in the gutter. What do you have? So equity multiplier is 0.6, debt to equity is 0.9. Okay, pretty good. Lower than industry average. Interest coverage 21. So I think very little risk here. So from a debt, I wouldn't worry too much about this company going bankrupt because they seem to be doing pretty well. Assets per share is 1.5K. You don't usually see the number crowding out the decimal sign. I can only imagine what the share price is going to be looking like. So tangible book is 155, 1,550. Book per share 840. Wow, the numbers are huge. Why do they have so few shares? They should issue more. Cash per share 760. Wow, 760 cash per share. That's a lot. Foundation to common 827. Dividends. No dividends? That's kind of weird, for an industry this mature and a company going back at least 20 years. No dividends. That is so weird. Why? Maybe it's that finance part doing its thing, right? They're taking the cash they have on the books and they're using it to finance. I don't know what the mortgage segment does. Maybe you should look at that separately before talking about it. So, all right. Okay, this is good to know. That's fine. Let's see. Let's see how the operations look like. So we said we can expect gross margin to be roughly around that 30% mark. You're looking at 20% here. So it's actually less. Their cost of goods sold relatively high compared to, okay, so it's actually 22% here. EBITDA margin is 16, operating margin 12. Okay, so the difference means operating margins EBIT. So depreciation, amortization accounts for 4%, a 4% drop. $300 EBITDA per share. These numbers are huge. Net income margin 12%. This is really good. This is really good, especially in 2020. How did they get such a high, even historically? Like the net income margin is pretty high. Historically. They actually did well in 2020. Like how? $244 per share in earnings. Whoa. Okay, I can only imagine what the share price is going to look like on this guy. Whew. Operating cash flow 250, free cash flow is 246. Yeah. So growth in free cash flow per share, and that's nice. Net cash flow is up as well. Yeah, no share buybacks. They actually did an issuance. And debt's up too, so they took on some debt. All right. Uh, this looks good. Like I don't actually see anything wrong with the business here. It looks pretty good. Looks pretty good. So asset turnover is a bit high, but still, much lower than industry average. So this is a really well-run company, from what I'm looking at. The return on equity has been pretty strong. Return on invested capital too. It's really good. Yeah. Yeah. Looks pretty solid. Like I don't see any red flags. Like I'm not seeing anything of huge concern here. Let's take a look at price, shall we? Brace yourself. I mean, if I were to kind of think about it before looking at price, I would say it's probably going to be a multiple on EBITDA. So multiple on EBITDA or multiple on EPS, whichever you like. They're not. I mean, if I were saying a multiple on EPS, maybe 15 times. So 244, 15, 3660. 4539. Wow. Okay. That is more than 15. It's 19. Wow. So historically, it's been roughly around 16 to 20. It was crazy in 2017. But other than that, it's been roughly around, so past 10 years, roughly around, yeah, 17 to 20. Call it 17 to 20. And now it's a bit on the high range. It's at 19. So pretty high multiple, I think. It's pretty high for me. There's also, I think they have reference here. Yeah, PE. So industry PE is roughly around 9. This is forward PE, forward 1 year. What is historical PE? Projected EPS growth. Yeah, why aren't you telling me what the PE is for historic? Price to sales, price to book. So you can see industry price to sales is 0.9. What is price to sales here? Yeah, EV over revenue. 2.1. That's pretty high. That is pretty high. It's pretty high. Like historically, you're buying a company that's pretty highly valued. I mean, considering it's just cyclical, like in residential construction, like why are you paying 19 times? That's expensive. Yeah, I wonder if there's like an ETF for home builders. Home builder ETF. US home builder ETF. SU. US home builder ETF. Yeah, I want to compare. So we can compare. What is this? NVR. So I'm going to compare that to iShares US Home Construction ETF. That's ITB or XHB. XHB. Okay. XHB. So we'll compare that to the industry, which is XHB. All right, let's see how that's doing. Oh, okay. All right. XHB is actually up, and NVR is pretty low compared to the starting point. I don't like these percentage graphs because they kind of distort the picture and they're highly reliant on your starting point. So if we just pick random starting point here, September 2020, you can see that it's underperformed relative to the ETF, the sector-wide ETF. Huh, okay. Underperformed. So it's just up like roughly 14% since September. Zoom out a little bit. Wow. That sector did really well since March. Yeah. Yeah, it must have hit the gutter. So roughly 100%, and then, but yeah, it's definitely underperformed the sector, which I'm kind of thinking why. Like, Why is it underperformed? Maybe there's a good company. Maybe its growth prospects are not as good. I don't know. Like I'd want to understand why is it underperforming? Why is it underperforming? I mean, it looks pretty good. It is expensive though, so I'm not crazy about the idea. Plus, there's that question around. Okay, let me see in NVR. Let me see what's going on with NVR here. I do not like the mortgage thing that's going on. Maybe this is normal. I don't know. Yeah, I want to see the document. So I see the breakdown. Selected financial data, home building, and then mortgage banking data. So you can see, honestly, revenues, income. All right, income pretty small. Income pretty small relative to home building income. Revenue, banking fees. All right, this is all in thousands. So 140 million in income versus okay, so fees plus I imagine they collect fees plus income, right? So they collect the sum of it. So 350, and then the rest of it is 937. So about a third. Overall, it's about a quarter of the revenue comes from this mortgage thing, which I don't like. Yeah, I don't like that whole mortgage thing. I just don't like it. I don't like it. I don't think it'd be considered that either. So, you know, that's a concern. That's a big concern, right? So yeah, not entirely sure, you know what I'm saying? NVR. I mean, I'm gonna think home builders industry review. 25% of revenue comes from mortgage segment. Mortgage segment. So yeah, I'm probably leaning towards this being not halal. Yeah, I don't think it's so very low risk. I don't see no red flags, no big red flag, no obvious red flags. Story looks okay. Miss 25% of revenue coming from mortgage. I don't know. I don't feel comfortable about that. And so yeah, nothing more to say, right? Cool. So that's NVR. Let's see. I'm just gonna pass on this, just by virtue of the fact that a large portion of the revenue comes from something that isn't halal. On the plus side, we also have a bunch of companies that we can compare this to. So let's take a look at some of its peers and get a feel for whether they have the same issue. So you can see home building businesses acquires and develops land primarily for residential purposes, constructs housing on such land. Cool. Also arranges financing through origination of mortgage loans primarily from home buyers. Selling the service rights for the originated loans, provides title insurance policies and examination. Same deal, right? Same deal. PHM. Okay. All right, PHM. Yeah, I mean, I'm just going to cut to the chase and try and figure out exactly how much of their revenue comes from. I just want to know how much of their revenue comes from the mortgage business. I don't really want to waste my time with businesses that are not halal, in my opinion. So you're looking at 362 plus 180. That's roughly 550, 560. So 560 out of 1.5. That's almost exactly the same as that last one. So about a quarter of the revenue comes from financial services, mortgages, that sort of thing. So it's like you're looking at the same thing, man. You know, you're looking at the same. Like I don't know what to do with this. I don't think it's gonna be considered. Okay. Point group. PHM. Yeah, I'm just gonna say same thing. It's gonna be the same thing. I might as well just copy paste the whole darn thing because it's exactly the same, right? NVR. Yeah. So what else? What else we got? So besides PHM, what do you got? Toll Brothers designs, builds, markets, sells, and arranges finance. Oh dear Lord, not again. Not again. Yeah. So I'm gonna go out on a limb and assume that this guy does the exact same thing as those other guys. Probably the exact same, yeah. I'm almost certain that's the case, but let's check. Let's check and see. Annual report. When was the last time they filed an annual report? 2019? What are you waiting for? We're in March. Whew. They're taking their own sweet time, aren't they? All right, I'm just going to jump to financial data here. What is this? Why does the annual report look like this? $2016? No, wait, that's old. Oh, here it is. 2018, 2020. This is the last annual report. The arrangement is messed up. All right, selected financial data. Okay. So you can see net income, sale revenue. Where's the mortgage stuff? So you can see home sale revenue, 6.9 billion. Wow, that's huge. Mortgage. Okay. Amount finance, 1.7 billion. Where's the mortgage stuff? I want to see the numbers for their mortgage. Oh, come on. Mortgage company loan facility. I think they just consider it because they don't issue or they don't originate the mortgages themselves. They use a loan facility. It's because I think what's happening is they don't originate the loans themselves, and so as a result, they're not. Right, so you can see ranges finance, but they don't do it internally, right? They do it through some sort of partner company. Okay. All right, so I don't know what the situation would be. Fully owned mortgage subsidiary entered into a mortgage warehousing agreement to finance origination of mortgage loans by TBI Mortgage. Okay. All right, whatever. Like, clearly a portion of this is going to be related to mortgages. I don't know what that portion is, and they don't make it easy to find out. But yeah, the income margin is pretty good actually. I've seen a lot of red like the past couple of years. Yeah, the only difference is the first quarter, but it picked up. Yeah, margin picked up. I mean, this is understandable, right? 2020, 2019. Yeah, I don't know what to make of that. Like, it probably shouldn't have had a huge impact, but seeing some red. Cash flow looks pretty good. Definitely a huge uptick in that first quarter. Look at the impact that had on TTM free cash flow. Yeah, return on invested capital is pretty rubbish. Return on equity is high. I wonder if that's because of the whole mortgage thing, right? That's going on. Return on equity just goes really high because they're using leverage. maybe, probably. So because they have a wholly owned subsidiary that's doing all of this stuff, they don't consider it as a it doesn't show up in these books. Yeah, probably. I don't know. I don't know how they account for that actually. Let's compare that TOL. Wow, they've done insanely well. Look at that. Whoa. Oh, 260%. Yeah, I mean, since Jan, it's done really well too, right? Since Jan. Should have done this review sooner, huh? Look at that. Wow, 33%. Yeah, that was since November, though. Yeah, since Jan, it's closer to 27%. Yeah, definitely overperformed relative to the benchmark here, which so now you have two companies. You have TOL overperformed, Toll Brothers, and then you have this other company, which underperformed relative to, right? See, the starting point makes a huge difference here, right? The orange is the index. Makes a huge difference. That's why I don't like these percentage scales. But then you'd have to have separate scales for each one of them. Whatever. So okay. All right. Cool. And so yeah, home building. I don't know. You know, it's gonna be a function of what your outlook on the economy is, and if you have a negative outlook, it's not gonna look good. Yeah, it's gonna get a lot worse, right? Plus the reliance on leverage. You know, I don't like that at all. Plus interest rates rising gonna have an impact on like the industry. I don't know, man. Like I don't know. I don't know. Let's take a look at a few more. So VLD, installation and other building products to the construction industry. Installation, distribution. Okay, none of that financing crap, right? That's good. I like that. What do you got? 2.7 mil. Oh, they reduced their debt in 2020. Bought back some shares too. That's our equity 1.1. Cash ratio is 0.7. Not great. You know, there's a bit of a risk here. Revenue is growing sustainably. It's pretty good. Huh. Assets, tangible book. Wow. Whoa. Tangible book is 36 of 85 in assets. What's going on with their intangibles? What on earth happened? Whew. Whoa. 1.6 billion in intangibles. Yeah, I'm gonna ignore that. You can bet I'm gonna be ignoring that. Like, just write off all intangibles if they don't exist, because there's no way. I mean, I don't know why. This is an acquisition. Probably an acquisition. All right, cash per share is 10. Liquidation to common is negative. Don't like that. No dividends either. Gross margin 27%, 15 EBITDA. Operating 13. Net income is 9. I like the 9% net income, but historically it's high. I mean, the average is probably looking at roughly 30%, 5%, right? Okay, 8%, 7, yeah, 7, 8%, 6%. So okay, EPS 750. Operating cash flow consistently positive. I like that. That's nice. Free cash flow is positive too. That's great. Okay, I like this. I think it's a strong business. Return on equity, pretty good. Yeah, I like it. I like that return on equity. I like return on invested capital. This is good. This is good. So they're keeping some cash. Return on invested capital is pretty high, but because they have quite a bit of cash, and equity is, what is equity? $40 a share. Yeah, That's pretty high too. So yeah, return on equity is lower. Okay. All right, cool. I mean, I don't know what you're gonna value this at, but if it's multiple on EPS, multiple on earnings is say 15, 20. Whoa, 26. Whew, not cheap, huh? I mean, historically, you're looking at 15 to 20. What on earth happened in 2020? It just blew up, right? Uh, yeah, yeah, no. I mean, I would have liked it here. This would have been nice. Why would you pay so much more? Like it's so much more expensive now. 2.4 versus, historically trading at roughly, yeah, roughly revenue rate. I mean, here though, this would have been a great buy, right? 18 times the earnings, 12 times EBITDA. I like this. This price I like. This, I mean, forget that. It's actually worse. It's a whole lot worse now. Yeah. EV per revenue, 2.5 times revenue, 4 times, 5 times tangible book, 5.3 times tangible book. That's a stretch. 16.4 times EBITDA. That is high. I don't like it. I don't like it. Again, this isn't like a home builder per se. This is an engineering construction company, industrials. I guess their primary thing is home building, right? Well, no, I think it commercial general contractors, remodelers, individual homeowners, as well as installation contractors, gutter contractors, other contractors. Yeah, okay. Okay. Yeah. I mean, it's all right. It looks like a good company. I think this would be a nice company to invest in. Not at this price, though. This price is insane. 195. I mean, I'd consider it at, it's, I don't know what to tell you. Like, okay, maybe if we consider it 15 to 20, I'd be happy at 20 times earnings. Okay. So what are earnings today? 7.5, 20 times 7.5, 150. I'd be happy at 150. 195? I just don't see it. I don't see it. I just don't see it. So I'm gonna set up this alert for BLD. I'm gonna set it up and I'm gonna have it at 150. And that's it. We'll see. We'll see. BLD. I'm gonna put 150 on here. And whenever it hits, it hits, I had quite a few of these I bought into a few days ago. It's so good to get that email, Wow, Trinzeo's below 63. This is a nice company again to chemicals. All right, cool. I already have it on my buy list. I've already bought it, so nothing to worry about. Okay, so that's BLD, KBH. What's KBH? Home building. Okay, back to home builders. Company also offers financial services. All right, so you know the drill. Let's get the SEC for KBH. Yeah. Annual report. All right, there we go. Pretty recent. Just filed. Mortgage. Home building revenue. Yeah, okay, just show me financial data. All right, so revenue from financials. Okay, all right, this is nice. I like this. Revenue from financial services only 15 million versus 4.1 billion in home building. This I can get with, I can get with this. It doesn't seem like it's a huge part of their business. 36. So even in terms of just pure, if you look at pure income, right? Operating income, 11 versus 316. So roughly 3%. I like this. This is good. You know, this is a business where I can say, okay, you know what? I'm comfortable investing in this. If it was 33%, no, don't. I'm not interested. But this is okay, you know? At least to me, you know, it seems like it's not the whole financial services segment is just incidental. And I think even if they were to get rid of it entirely, it's not gonna make a huge difference on the business itself because it's only 3% of income and a tiny sliver of revenue. It's like 11 versus, yeah, it's ridiculous. 4 point something billion in revenue versus 30-ish million. So tiny sliver. So this I'm okay with, and it seems like all right, that initial test is passed. I'm okay with looking at this and kind of diving a bit deeper into it. So let's go ahead and do that. KBH. Let's go ahead and do that. Yeah, we can just copy paste all this stuff and keep going. And so let's see. Right. So yeah, less than 3% of income from financing. So I'd consider this. Let's take a look at their credit assessment. So what do we got? Revenue dropped in 2020. Big shock, right? I know. Whoa, back in 2016, they were doing ridiculously. 2006, they were doing ridiculously well. Then 2008 crashed, and then everything just went to the gutter. And they've been slowly recovering since, right? But wow, look at this crazy reset here, from 9 billion revenue, all the way down to 1.8. Wow, that's pretty bad. That's a huge, like almost a 90% drop. Madness. Okay, so they've been issuing some shares. Okay. All right, let's take a look at the debt situation. So, okay, they've been lowering their debt since 2016. I like that. That's good to see. Debt to equity is at 1. Okay. All right. 0.5 multiplier. I don't see any ratios here. Not usually a good sign. Yeah, I don't know what this one. Why don't I see the ratios? How much cash do they have? So 681. Okay, 681 over what are their short-term liabilities? I don't know why this formula isn't showing up. Current portion of long-term liability. Oh, they don't have any short-term liabilities. That's why. Oh, this is wonderful. No short-term liability. This is great. I love this. Okay. All right. Cool. So that's why. So credit situation, really, really good. I'm not worried at all about their credit situation. That's nice. This is wonderful. So I want to take a look at. Okay, man. Actually, there's one more thing we can check. The bonds. See if they have any bonds issued. You don't see this very often, but for a company of this size, I think they might actually have some bonds. You can take a look at. Okay, see the yield. Oh, this one. Yeah, I mean there's a bunch of them, but if we look at say this one. Oh, looks pretty good. Looks pretty good. I mean yield not that high. Price chart dropped like crazy here. People were worried maybe that it would go insolvent. But prices have since resumed, so I think it seems all right. Like as a yeah, it doesn't look like it's trading at a discount. So all right, that's cool. So credit situation looks pretty good. Looks good. Low risk of bankruptcy. Yeah, I wouldn't worry about that at all. Red flags. Let's take a look at what they have first. Tangible book is exactly assets. I like seeing that. Book per share is 29.4. Cash per share is 7.5. Liquidation income is 29. Okay. Dividend. Isn't that a nice breath of fresh air, right? They're actually paying dividends because they don't have any of that financing crap going on. I imagine that's why, like they can actually pay out the cash that they have on the books. So that's nice. 0.4, pretty good. So let's take a look at their numbers. Gross margin is 20% less than industry average. Maybe worth looking into. Beta margin's 9%, high, relative to historical levels. And what else we got? So beta per share is $4. Operating margins 8%. Pretty good, like relative to historical figures. Net income is 7%. Man, I like the net income margins on these businesses. I like them. I mean, gosh, what on earth happened in 2014? Must have been like a one-time thing, right? Crazy tax credit. I don't know what that would be. Man, it actually went negative back in 2008. Yeah, it went negative like crazy. All right, anyway, so earnings per share, about $3. Pretty good. Operating cash flow been positive for a while. Cool. I like this. So net cash flow dipped negative for a bit while they were repaying debt, but looks good. I like this. I like that. The numbers look pretty good. Margin's a bit low. Okay, I should be specific. The gross margin's a bit low. Gross margin lower than industry average, but not that much lower. I don't know if I'd be concerned about that. Probably not. Return on equity. Okay, again, like you don't have any of that leverage, and so it doesn't look crazy, but I think it's okay. 10-12% solid return on equity. Return on invested capital is 2 to 6%. Okay, all right, yeah. This is low actually, but again, like they don't have debt, so I wouldn't worry too much about that. Yeah, I'd worry more about return on invested capital if they had leverage, because then you need to make sure that your return on invested capital exceeds the leverage or whatever debt you've got on the books, the rate of debt itself. But I don't know if this is going to get squeezed. Like, yeah, I mean, given the industry outlook, there's a good margin there. Return on equity. Plus, again, remember, they're paying dividends, right? That's good. Cool. So price, I don't know how to price this. If I were going to say multiple of earnings, say 15 times earnings, that's 45. 43. Yeah, that's pretty good. 12 times earnings. So historically, no, 13 times earnings. Historically, roughly around that figure. It's a bit high historically, but not too shabby, not too shabby. Not too shabby. KB Home. 0.7 times tangible book. So this is high. 1.4 times book. I mean, it's definitely lower. Like, so right now it's 1.2 times revenue. If you compare that to this 2 times revenue, this bad boy is, all right, PHM is 1.2 times revenue, but 2 times book. 2 times a book. Here you're looking at 1.4 times book. But it doesn't even compare like in terms of price to equity. Price to earnings, PE. 9? Really? Oh, that's low. This is low. It's actually high compared to PHM. XHP. Let me look at price, KBH. I might actually buy this, or open a small position just to kind of monitor it. It's been rough the past period. but probably, yeah, probably in line with how the XHP Homebuilders ETF. Yeah, underperforming the ETF. Yeah, the other thing I like to do is actually figure out how it's doing relative to earnings. So the way I do this is I take, for example, what was this again? KBH. KBH. Right, so I plot KBH. And then I also take a look at EPS, diluted EPS trailing 12 months. And I look at, say, 5 years. And you want to open a position when it's dropped, like your earnings per share, like when the price is below the earnings per share line, historically. That's what you want to. So right now, price is, as long as the earnings per share don't dip here, and price ends up breaching this earnings per share line, you're okay. So yeah, it looks like it actually will. Yeah, you want to buy like somewhere here would have been nice. Somewhere well below the earnings per share line. There's also EPS. I don't think normalized would make a huge difference. Yeah, probably not a huge difference. So about the same. So you want to buy. I'd be interested to see what earnings per share looks like for the coming quarter, but. They're doing it by month. Three years. Okay, yeah. Now it's breached the earnings per share line. Unless you see a huge increase in earnings per share, I'd be a bit concerned. Yeah, I'd be a bit concerned. So it's probably not a good time to be buying this now. But what price would I buy it at? That's the question, right? So I like the company, but yeah, that earnings per share line. Yeah, I'd be a bit concerned about that. Let me just take it again and kind of highlight what I'm talking about here. It's this area right here that I'm concerned about. Price outpacing earnings. That's what you don't want. What's RSI look like? Yeah, I mean, right now, RSI looking like roughly at the 50 level. So I like getting in at roughly 50 level, but I mean, that's not a huge deal for me. The bigger problem is this whole earnings thing, right? The whole earnings things, because they're probably going to revise earnings based on housing starts, and if housing starts dip as they did historically, that's going to have a huge impact on them, right? So that's the concern. Okay. All right. Show me absolute values. Don't give me this crap. Yeah. Plus, I want to see a log. So 43. 43. Yeah. I don't actually care about this anymore. So 43. Yeah. RSI is roughly 50 now. I don't know what to tell you. I mean, it's gonna depend on the coming earnings. Maybe I'd think about it around 39. I'd look into it again around the 39 level. Yeah, it just seems high historically. I don't know if it's a good time to get in. Like 39.3 if I had to. Yeah. I'm gonna add an alert for around 39. This is a good company. KBH. 39, let's say 39.3. Yeah. Cool. I like that. All right. Oh, they have a list here. We actually went through KBH, went through what else did we cover? PHM. Covered PHM. Let's leave that. All right. All right, cool. So let's see. How many more do we have? All right, I like this. So let me take a photo of this. Yeah, I need to find a better way to do this, but I currently just take photos of the darn thing and put them in. Oh yeah, the other thing I like doing before I decide to purchase or not purchase is take a look at Seeking Alpha, try to understand what the outlook might be for the company. So not much coverage, huh? Oh, they released results yesterday? Oh, come on. Get out of my way. Revenue misses, consensus as community count dips. What is that? Slides 3.7% after hours trading. This was literally yesterday. Better positioned for meaningful growth. They don't provide any 2021 guidance. Oh, okay. It beats, EPS beats by 0.07, misses on revenue. Okay. So EPS is up, but revenue missed. Huh. Interesting. Yeah, it might actually be a good time to buy then. So they released this after hours yesterday, right? 5 p.m. ET yesterday. So you're going to see a drop today, right? 3% drop. And the price currently is 43. So 3% off 43 is probably going to be around. Yeah, it's not going to be significant. Like, oh, 1% is going to be 40 cents. Yeah, a buck. And not huge. Not huge. And again, I'm looking at around 39. I think 39 would be fantastic. Overall market conditions, supply remains tight, existing home inventory down 30% year over year. Mortgage rates are down year over year, remain attractive. Around low 3% range for a fixed year mortgage. Cool, that's good context to know. Okay, all right, cool. So that's KVH for us. Pretty good actually. I like that. I like that company. A lot of these you have that issue with the mortgage being a substantial part of their business, and it doesn't sit well with me. But KVH didn't have that problem. So let's take a look. Mdc Richmond America. These are big companies, huh? You're looking at 3.9 billion revenue. Home building operations, purchasing finished lots or developing lots. Single family detached homes to first time move up home buyers. Okay. Financial services operations comprise originating mortgage loans. Here we go again. Here we go. So, CCMDC. Let's take a look. Let's take a look. Don't write it off just yet. You know, you never know. You never know. You never know. Let's take a look. So, what is this? MDC Holdings. All right. Oh, we got colors. You don't usually see colors. Not applicable? What is this crap? What do you mean it's not applicable? Okay, here. Operating income, media and data net. What? What is this? MDC Partners. This is not the same business. Canada Business Corporations. Yeah, sorry, man. It's not the same business. I think I clicked the wrong one. MDCA. Yeah, I want MDC Holdings. Yeah, this one right here. All right, cool. All right. So here we go. Home building revenue 3.7, 135 million. Okay. All right, this is good. Again, another 3%, roughly 3%. Financial services income, 78 million. Home building pre-tax income. Can I just see the final net income? Okay. Okay, no, you can't. 78 over 378. 20%. I don't like it. I don't like it. I mean, it's a small portion of revenue, but the income, though, is substantial. Income is substantial. It's 20% of income. Nope. I don't like it. I don't like it. 78 million versus 378 million. Yeah, substantial. Financial services pre-tax income is 78 million versus home building pre-tax income. Yeah, substantial. Cool. So no, I'm not gonna be looking into this. MDC. Sorry, MDC. Not happening. Not happening. So it's gonna be a not for that for me. 20% of net income from mortgage business. All right, so I'm not gonna bother with the rest of these. So that's it. I mean, these are all the peers for NVR, and let's take a couple more. Let's take a couple more. I'll take a few more from what is this? Hovanian. Hovanian. Or maybe a couple from here, huh? BZH. BZH. Yeah, let's try that. Century Homes. What is that? All right, it's BZH. Beazer Homes operates as a home builder in the U.S. Single family, multifamily homes. Great, no financing. I love this. Cool. So let's take a look at revenue. Revenue's nice, trending up. Shares trending down. That's exactly what you want to see. Debt, yeah, roughly stable. I mean, they've been dropping debt since 2015, but they raised a bit. Yeah, a tiny bit, like $1 million more in 2020. This is good. They've been paying back debt. Debt to equity is high, though. I mean, it's half revenue. More than half. Yeah, debt to equity is high. I don't like that. You don't want a company that's got a lot of debt. 1.1 billion versus 2 billion revenue. Why are all these ratios here? What's going on here? Quick ratio, cash ratio. Come on, guys. I mean, show me. All right, so you got some cash. And then, Where are interest expenses? Oh, come on. I still don't have the income statement in here. I really should get to it. I really should get to it. I can't see interest expense here. Right. Yeah. Quick ratio, cash ratio. I don't know. Why are these not showing up? That's weird. That's weird. Beezer Homes. All right, so tangible all the way, book share. So yeah, I mean, I don't know about Beezer Homes. Need to do a proper credit analysis, understand what's going on here. But if I were to quickly take a look at the numbers, net income margin is horrible. Wow, that's razor thin. This is very concerning. Operating margin really low too. Beta margin, not great. Not great. 2019 was a horrible year. What on earth happened? Revenue dipped? Wow, that's pretty bad. What on earth happened in 2019? That's ridiculous. This is scary. Yeah. Return on invested capital, pretty horrible. And then ROE is okay. I mean, it's acceptable. This is better have a horrible multiple. PE is 9. I don't think it's even worth that, I'd probably, yeah, I'd probably pick less. Debt to equity, why is it so high? Yeah, not nice. I don't like this. I don't like this. BCH. Beezer Homes. Let's see. Revisiting Beezer Homes. This is back in December 2020. Yeah. Nope. Nope. Yeah, I just don't see it. I don't see it. Sorry. Beezer Homes. Not looking good. Not looking good. Yeah. So don't care about Beezer. What else we got? CCS. CCS. Let's take a look at CCS. What happened there? All right, CCS issued more shares, took on more debt. Not what you want to be seeing, Debt to equity is pretty low. Revenue is substantially higher. Okay, let's read the description. Design, construction, marketing, sales, single family homes, development of underlying land, provision of mortgage, title, and insurance services. Yeah, I don't know about that. Net income, okay. All right, it's decent. It's decent, and not horrible. Negative operating cash flow in 2019, and before that, it was even worse. What happened? Why was it so bad back here? Well, revenue was really low. Yeah, but operating margin was okay. So where did net income go? How'd it go negative? Operating cash flow. What? I don't get this. You have positive net income. Why is operating cash flow negative? Write-downs? The non-cash items are negative? What? It's like I imagine like depreciation, amortization, and all that stuff actually ends up being negative, actually exceeds your cash-based items. It's pretty crazy. Huh. Okay, that's kind of weird. I don't know why that is. I'd want to dig into that. Why do you have negative operating cash flow? That's not good. And why are all of these empty? I get a weird feeling when I see all of these empty. This is scary because it tells me something's going on. Like Debt to equity 1.2. Not the best in the world, but not bad either. Industry average is 1.1. Assets per share 85. 84 tangibles, 38. Okay, not bad. 38 book value, cash per share is 12. Okay, decent. No dividends. Liquidation common is 37. Yeah, I like it. I mean, I think the numbers are okay. Doesn't look horrible. Operating cash flow. Why was operating cash flow negative? This is what I don't understand. Why was operating cash flow negative here? Huh. It's pretty crazy. Huh? I mean, look, this is how I look at it, right? This is your operating cash flow, cash from operating expenses. Typically, if your net income is positive, you're gonna add back all of these things. So depreciation, amortization, you're actually gonna add it back. So if you took on depreciation, amortization expense, you can add it back. You're gonna have operating cash flow is gonna be higher than net income. But then you also have like a bunch of other stuff. Changes in working capital that could have a substantial impact, and I think that might actually be the case here. Like if you have negative working capital, so you had a huge change in working capital, a huge negative change in working capital, then that's going to impact your net income. That's the, I mean, maybe that's what's going on here, right? Hmm. Yeah, possible. Possible. All right, cool. Cool. Anyway, low multiple. Definitely give me a low multiple. It's 9. Yeah, I'd venture even lower. Like I'd say probably 7. 7's a good multiple for this kind of business. Plus, you need to do proper credit analysis. I don't know what's going on here. So, if I were to take a look at this, I'm not saying I am. So, if I were to take a look at this, what I'd want to know is, I don't think I put that on that other. So, this is an industry review. So, I don't know. I need to look into that a little bit. Do proper credit analysis. Red flags, negative operating cash flow. So this is despite positive net income. It's kind of crazy. Story. Yeah, I don't know about the story. Maybe we should look up the story. Do you think there's something there? You never know. You never know, especially for, I mean, it's not that big a company, 3 billion. I don't know. Gradual construction of real growth and security. Do you know what you're talking about? Let's see. No dividends. Remains undervalued by PE ratio. Yeah, it is pretty low, but I don't know if it's undervalued though. Why is that a ticker? Yeah, I get to the point. Exceptional expenses. Maybe that could have counted why. I don't know, man. Like, I actually need something. I need to see something. Return on assets may increase to 6%. Return on equity. FFO, free funds from operations. Yeah, I mean, I don't know about that. I don't know about that. How did I miss CCS from 10 to 60 in a year? Yeah. 10 to 60, huh? Yeah, it's a bit on the high end. Whoa, look at that. Wow. Forget 10, it was 9. 9 to almost, yeah, I think it hit 60. It exceeded 60 here. 63. Looks pretty strong though. Wow. That's crazy, huh? 56. Earnings probably coming up. I bet that's gonna be negative. I mean, it looks like there's something going on industry-wide. How does this compare to XHP? Yeah. Well, it was underperforming for a while, then hit par, and now, yeah, it's overperforming like crazy. Yeah, I don't know. I mean, at this rate, I don't know. I'm not excited about it. Just not excited. Let's see, this rate, I don't know. EV per share, yeah. It's less than 1 times revenue. 0.6 tangible book. EBITDA is 9. 9 times EBITDA. I don't know, I don't know. I don't know what to tell you, CCS. I need to probably see something. I mean, I'd want to see maybe some insider buying. Right, so some bonds, B plus. Okay, 2025. So what the yield looks like. Not great. Dip like crazy. Okay. All right, interesting. I mean, is there any insider buying? Quite the opposite, huh? Everybody's selling. 6 mil. Co-CEO sold 6 mil. Yeah. Not encouraging. I don't know, man. Like, I just don't feel it. I don't feel it. CCS. I don't know. Murky waters. Not sure what the outlook is. That unclear. I mean, that situation unclear. This is I didn't do the proper credit analysis, and also what? Also pricey. Pricey relative to, and maybe it's 7 times earnings I'd consider, but earnings, there's a huge jump last year. I mean, average earnings is probably around 35. I mean, I'd look at it around 30, 35, I think would be good, but I just don't see that happening here. So yeah, that's it. All right, guys. So I think this video has gone for long enough. We found a few opportunities here. BLD, KVH. Still a bit pricey, so I'm not gonna jump right in. But if it drops a little bit, then I'm gonna dabble. Gonna open a position in BLD probably soon. But really dive in at below 150. That's where I want to get. And then and yeah, as an industry, it looks pretty solid. I think if the economy recovers, you're going to see strong growth in housing starts, and this sector as a whole, this industry as a whole is going to do pretty well. So yeah, excited to see how this turns out, and I'll look at other opportunities separately, and if anything changes, I'll add them to the comments below. But thanks for tuning in, and I'll see you in the next industry review. Adios.